My name is Dominique, but you can call me Dom. And today I will be teaching you accounting, particularly identifying general principles in accounting. And those three principles that we are going to be discussing today is the economic entity assumption, monetary unit assumption, and time period assumption. So just a quick outline of how our discussion will flow. I'll be explaining a quick background on the general principles and what they are, and I'll be discussing the three principles, the economic entity assumption, monetary unit assumption, and time period assumption. And we will end with a short summary of the highlights of the discussion. So let's begin. So what are generally accepted accounting principles? These are basically the widely accepted set of rules, concepts, and principles that govern the application of accounting procedures as seen in the shared screen slides. So I guess you can say in a very short version that it's a set of rules and principles that accountants follow when they prepare their financial reports. Now you might ask, why do we have these? What's its relevance? Well, this actually standardizes accounting procedures and reporting. If you think of accounting as a language of business, then there must be some sort of common language so that all business officials from all over the world can understand each other and understand each other's financial reports. Well, that's where generally accepted accounting principles come in. They were developed by accounting professionals so that everyone all over the world can understand the financial reports even if it's not from their own country. So imagine someone from Australia will understand the financial reports of a business executive in China, and that's how the generally accepted accounting principles work. So what are underlying assumptions? They're part of this gap. And this is basically the perspective that financial statement preparers presume when they make the financial statements. And the key in understanding this is understanding why such are the assumptions. And we have to have a good grasp of these assumptions because through this we'll be able to understand why the accounting data is processed and presented as such. So moving on, the first underlying assumption that we are going to discuss is the economic entity assumption. And in one sentence, it's just basically the business is a separate and distinct entity from the owner. So the personal assets and liabilities of the owner and his or her personal transactions should not appear in the books of the business. Just think of it as separating your business and your personal life. So what does this mean? For example, you bought a car for your own personal use. You do not have, and you were actually not allowed to put this transaction in the books of the business. The only exception is when this personal transaction actually coincides with the business. So for example, you as an owner, you want to invest a printer into your business. Since you are basically bringing a new asset into the business and you are increasing the value of the business, this is actually an owner's investment transaction and this has to be recorded in the books. Similarly, for example, you have a daughter and you are going to pay her tuition fee from the money of the business. This is actually a transaction that should be recorded in the business because this is an owner's withdrawal transaction. You are taking away a sum of money from the business capital to pay off your personal expenses. So that's the economic entity assumption for you. The second assumption that we are going to discuss is the monetary unit assumption. The monetary unit assumption can be categorized into three sub-concepts. The first is using the currency of the country. So for example, I'm a Filipino and I'm preparing the set of financial statements for a Philippine corporation that is located in the Philippines. Then I have to use the Philippine peso in preparing my set of financial statements, and the same goes for whatever else country you are in. So the second part of the monetary unit assumption is that you have to assume that the currency is relatively stable. That is, whatever currency we are reporting in. So you might be wondering, then how do accountants take into account the effects of hyperinflation or deflation? Well, there's actually a guideline for financial reporting in hyperinflationary economies although it has not really been used that much yet in the Philippines, just a fun fact. So there is that guideline to account if ever there is any hyperinflation happening. Then the third part of the monetary unit assumption is that we only record monetary transactions, that is, any business transaction that can be quantified into money, and it usually involves the money exchanging hands between the business and outsiders. So if there are any non-monetary transactions, then they can only be recorded via a memorandum entry or not recorded at all. An example of this is a contract signing. You signed a new employee to be part of your management team. This is actually non-monetary in nature since there's no money involved, exchange or any money exchanging hands when one signs a contract. So this is not recorded in the books. So the third underlying assumption to be discussed today is a time period assumption. So the time period assumption is grounded on the idea that we as accountants have to provide periodic reports of the economic activities of the business to the users of the financial statements, because this aids for good decision making. So how do we do this then? We divide up the life of an economic entity into equal and artificial time periods. So these time periods can be done monthly, quarterly, or annually. And we have to take note that it has to be equal, and all the business processes and all the accounting procedures have to be completed within whatever time period you choose. So if you do choose annually, we actually have two kinds of years. The first is the calendar year, which is just a regular calendar that we know about. It ends on December 31. But the fiscal year does not necessarily have to end on December 31, though it may. So I've actually seen some financial statements that end on April 30 or any other time of the year, whatever the company decides to choose. And the important part about the time period assumption is that you actually have to include in the header of your financial statement for what time period this financial data encompasses. So that is the time period assumption for you. Just a quick recap. We have a short introduction to generally accepted accounting principles, which is just basically standardizing financial reporting. This is very important because it creates a sort of common business language for everyone that uses the financial statements. And understanding the gap and understanding underlying assumptions is important because it helps us get to know and have a grasp of why such financial data is treated this way. So I discussed three underlying assumptions. First is the economic entity assumption, which just basically entails that the books and transactions of the business and of the owner should be separated. Of course, unless there is some link between the two, that is, the personal transactions of the owner is actually involving the business, as in with owner's withdrawal and owner's investment. The monetary unit assumption basically entails that financial statement preparers must use the currency of the country or the domicile of the company that they are reporting for. And we must assume that the currency is stable and that only monetary transactions can be recorded in the books of the business. For the time period assumption, this is grounded on the idea that we have to provide periodic reports to financial statement users. So we do this by dividing up the life of an economic entity into artificial and equal time periods. And we actually have two kinds of 12-month periods or years in accounting. We have the calendar year, which ends on December 31st, and the fiscal year, which may or may not end on December 31st. And the most important part of this is that we have to indicate what time period the financial data we are reporting for in the financial statement, what time period it encompasses. And it has to be done in the header of the financial statements. So that is all for today. I hope you guys enjoyed this lesson and learned something. Thank you.